Welcome everybody to another one of these exercise solvers here. And what I got for you today is what I like to call a combo question. Okay? What I mean by combo question is it's actually going to be, a question gives us all this, relevant information, and it's one that's going to involve us preparing more than one kind of statement. Okay? Oftentimes on the midterm, things like that, they're not just going to ask you to prepare just an income statement. Oftentimes, they'll get you to prepare an income statement along with maybe, a statement of retained earnings or a statement in changes in equity, because the information on the income statement is actually, relatable and will, affect the statement of retained earnings and the statement of changes in equity, which is why they're often asked together. So I just wanted to give you, a few combo questions. So in this video, I'm going to be doing the first, and then I'll also have another video where I do a second combo question, just to show you, the relationship between these three statements: the income statement, the statement of retained earnings, and the statement of changes in equity. Okay, so let's just jump right into this first one here. Hopefully it won't take us too long. So right here, we have the relevant information for the Sabra Corporation for 2015. So it's going to give us our net sales, 1.2 million. We have selling expenses, admin expenses, contributed surplus, beginning balance, right, or balance as of December 31st, 2014, interest income, common shares, loss from declined inventory, advertising expense omitted by mistake. We have a dividends declared, cost of goods sold, unrealized holding gain on fair value OCI investments, retained earnings balance December 31st, 2014, accumulated other comprehensive income balance December 31st, 2014, and common shares balance as of December 31st, 2014. So a lot of information. Sabra Corporation follows IFRS, okay, that's key to know, and they have 240,000 common shares outstanding, and the tax rate is 35%. Okay, so what we got to do? We got to prepare multiple step statement of comprehensive income, statement of retained earnings, and statement changes in equity. So of course we're going to start with the statement of comprehensive income, which is the same thing as a income statement. We just call it a statement of comprehensive income because, as you can see here, we have other comprehensive income. We have this OCI right here, and that causes us to, change the name of the statement from net income, or from the income statement to the statement of comprehensive income. Okay, just a little bit of theory there for you, not a big deal. Okay, so of course with anything we're always going to start with our header. So we are the Sabra Corporation, so that is our company name, Sabra Corporation. What are we making here? It is a statement of comprehensive income. Let me just fix, that O fixed by itself. Okay, and does it tell us what it's for? For 2015. So we're going to assume that it's for the year ended, for the year ended, I'm struggling here, guys. For the year ended December 31st, 2015. Okay, so we always start with our header right there. Pretty straightforward stuff. Okay, I'm just going to, tidy it up a little bit, put it together. All right. So, first thing we're always going to do, hope you know this by now, is we're always going to do our revenues first. Not sure why that is red. Odd. Okay. We always do our revenues first. Okay. So, for the multiple step income statement, in the revenue section, the first thing we like to include is our net sales. Okay. And net sales, hopefully you'll notice by now, equals sales minus sales returns and allowances, and allowances minus sales discounts. Okay, so we are going to be looking for any of these accounts above. So if we scroll through all of our givens, we do have, it gives us net sales actually, and if we scroll through, we actually are not given any sales returns or allowances, or sales discounts. However, it gives us net sales right away. Usually on a multiple step income statement, we list our sales and then subtract our sales returns and allowances, then subtract sales discounts to find net sales. But in this case, it just gives us net sales right away. So we're just going to take that and we're not going to calculate on the statement since it just gives it to us right away. So it gives us our net sales here of $1.2 million. Yep. And then that is basically it for the revenue section. We will then move on to the cost of goods sold section. Cost of goods sold. Okay, and again, I'll bold that there for you. Now, usually for the cost of goods sold, right, cost of goods sold equals, your beginning inventory plus net purchases minus ending inventory. So usually, I'm not sure why all this is bold. Okay, so usually, right, we would look for these accounts above, and then we'd calculate it under the cost of goods sold section. However, we are not given any of these accounts. In fact, it just tells us straight up what cost of goods sold are. So it's making our lives very easy for us. Now, if you want to see an income statement where we actually, showcase all the calculations, then check out the video that, that is titled the multiple step and single step income statement solution. Okay? Because that's where I actually prepare it, and I'm not just given all, and that's where I actually have to calculate all this stuff on the statement itself. So our cost of goods sold is going to be $670,000. Okay, just as it's mentioned right above right here. Okay, so we're just going to slap that right in the statement there. So after, throwing in our cost of goods sold, the next thing we always do on the multiple step income statement is calculate our gross profit, which is revenues minus cost of goods sold. So 1.2 million subtracted by 670,000 is going to give us our gross profit of $530,000. Okay? Pretty straightforward. And then after that, we're going to do our expenses. And in the expense section here, we're going to include our operating expenses. So for revenues here, right, we included our operating revenues. And then later on in the multiple step income statement, we'll have our own separate section for our non-operating revenues, which would be things like interest income. Okay? And so, for expenses, again, we include our operating expenses first. So these would be things like our selling expense and our admin expenses. And then, our non-operating expenses, things like, there's a loss from decline in value of inventory. This would be included, later on in the statement in the other expenses and losses section. Okay? So for expenses, all we need is our selling expense and admin expense. So we're just going to throw in selling expenses, and then our next one is our admin expenses. Okay? So selling expenses for the year are $350,000. $350,000. Oops. And then our admin expense for the year is $210,000. Okay, so just throw that in there. And then all we want to know is our total expenses. I don't know why that is red. We will change that right now. So we want our total expenses. And we're just going to add up our selling expense and our admin expense. So $350,000 plus $210,000 is going to give us $560,000. So now we have our operating revenues. We have, our cost of goods sold, gross profit, and we have our operating expenses. So since we have our operating revenues and operating expenses, naturally we want to solve for our income or loss from operating activities. Clearly, we're going to have a loss because, our gross profit is less than our expenses, our total expenses. So we're going to have a loss from operating activities, which is just going to be gross profit subtracted by total expense, giving us a loss from operating activities. Let me just spell that right there. Of $30,000. Oops, that's in the wrong spot there. $30,000. Okay? So now the next step of the income statement is going to be to put in our non-operating section. Okay, we have our operating section here, so now we need our non-operating section. So we always start with revenues, so it's going to be our other revenues and gains. So let's just go through the list here and see what is left, okay? We've already used net sales. We've already used selling expense and advertising expense. We've already used, what else have we used? We've used cost of goods sold, and that's about it, okay? So what we have left to work with here is this contributed surplus balance, interest income, common shares issued, loss from declined inventory, advertising expense omitted, dividends declared, unrealized holding gain, retained earnings balance, accumulated other comprehensive income balance, and common shares balance, okay? So that's all that's left. So what we're looking for here, right, is our non-operating revenues. And the only one there that qualifies for that is interest income of $53,500. So we'll just put that right in there. Oops. Again, that is red for some reason. And bold as well. Interest income of, what did I say? I believe it was $53,500. And that's the only one. So then we'll move on to our non-operating expenses. Okay? So let's look at what we have for non-operating expenses. Right, we've already used interest income. So we got a bunch of stuff left here, but honestly, all of these things, these contributed surplus balance as of, retained earnings balance as of, all of those are never going to go on the income statement. So we can go ahead and just cross those off because they are all shareholders' equity accounts that will be used for the later statements. So all we have left here is our common shares issued, which again, that's a shareholders' equity thing, so we don't need to worry about it. So all we have left here now is our loss from decline in inventory, which is a non-operating loss, right? So we'll include that. Loss from decline in inventory. Reason why it's non-operating is because the inventory isn't used in value every day. So we'll put that on the statement there. It is a loss, and it is a loss of about $6,100. Just put that in there, nice and simple. And let's look at, do we have anything else? We had this advertising expense omitted by mistake in 2014. Now, a lot of people would assume that, okay, that's an advertising expense. We forgot it in 2014, so, we should go put that on the statement here. We should go put in advertising expense. But that is a mistake, okay? The fact is that it was a mistake made in the past, okay? And past mistakes are never reflected on the income statement, okay? This income statement right here is for the year ended December 31st, 2015, meaning all this information here is supposed to represent everything that happened between January 1st, 2015 and December 31st, 2015. So although we messed up and we made a mistake in the past, this advertising expense is for 2014 and it does not fit on the statement because this statement covers 2015. Okay? So all of these, errors and mistakes from the past don't go on the income statement. So we will not be needing that. Okay? This right here is actually going to be used in the statement of retained earnings, and you will see that in just a bit. All right? And then we only have two other things here. We have this dividends declared, right? And a lot of people also might think, oh, dividends declared. There's like this dividend expense that we can throw on the statement here. Dividend expense. No, okay? That does not go on there. There's no such thing as like this dividend expense, okay? Dividends declared or dividends paid does not go on the income statement, okay? And that's something that you're going to need to know. And then the last item here is this unrealized holding gain on the fair value of OCI investments. Okay, now you might see the word here gain and go, oh my gosh, that's a gain. We probably should have included that in our other revenues and gain section. And you're on the right track in thinking that, but notice how it has the word OCI here. Okay, OCI stands for other comprehensive income, and other comprehensive income has its own section of the income statement later on. So while you're correct, yes, it is a revenue and it is a gain, it's not reported in the other revenues and gain section. It will actually be reported in the other comprehensive income section that will be showcased later on in the statement. Okay? So with that, this is literally the only item left to put in the statement, meaning that we have no other expenses and losses. So that's basically it for the non-operational section of the income statement. Okay? So now we can go ahead and figure out what our income is. Our income from, I don't know why that's caps. Our income from non-operating activities. Okay? You know, like we calculated our loss from operating activities, we're going to calculate our income from non-operating activities. So that's just basically going to be our other revenues and gains subtracted by our other expenses and losses. $52,500 subtracted by $6,100 gives us income from non-operating activities of $47,400. And I'll go ahead and get rid of this red right now. Okay. Now, after that, since there is nothing left to report, we are going to, except for this, unrealized holding gains, but this right here, right, this other comprehensive income section, it's actually reported after we've calculated net income and after we've calculated income tax. So we're going to go ahead and calculate our income tax, okay? But before that, of course, we need to go ahead and figure out what our net income is before tax, okay? Which is just going to be our loss from operating activities, right? I should put a bracket there just to make that more clear for you guys. You know, this loss from operating activities plus by our income from operating activities. Therefore, we have this net income before tax of $7,400. Okay? Now, of course, we're going to find our income tax. Get rid of that red and that bold again there, because, bolded everything there by mistake. Now we're just going to calculate our income tax, as we normally do. Income tax is 35%, as you can see right there. So, we're just going to take our net income before tax, $7,400, times it by 35%, giving us our income tax of $2,590. And from here, we can just figure out what our net income is. Pretty, straightforward. $7,400 subtracted by $2,590 gives us our net income of $4,810. Okay? But again, that's not all. Okay? We are not done just yet. Because, like I mentioned, there's the other comprehensive income section. Now, a lot of you may find it weird that other comprehensive income is recorded after net income. Because, you're used to the income statement and a net income, but you're just going to have to deal with it. Okay? And you're going to have to, accept the fact that the statement goes on. Okay? And that we have an other comprehensive income section. And always in the other comprehensive income statement, we always write this random sentence. I don't really know why we write it, but we always do. We always write items that may be reclassified and subsequently to net income or loss. We always include this right underneath the section. And I'll go ahead and format it all pretty there so it's all together. We always put this right underneath the other comprehensive income section header. Why? I have no idea, but it's what we do. And as we discussed, there's only one item that goes there, and it's this unrealized holding gain on fair value OCI. So we'll go ahead and put that in there. So unrealized holding gain on fair value OCI investments. Now I'll go ahead and fix my spelling right there. And I will figure out that it's $11,600. $11,600. Now, the thing is that this right here, it doesn't say that it's net of tax. Okay, this is the thing. All these numbers here are pre-tax numbers. If there's no brackets around it saying, for example, net of tax, then we assume that the number is a pre-tax number. Okay, and for all these other ones, that's fine. That's actually perfect, because all these numbers here would be listed pre-tax. And then right here, we calculate our income tax. So it's good that all these numbers above are pre-tax. However, everything recorded after income tax, expense has been deducted, needs to be reported net of tax. And unfortunately, this $11,600 is not reported net of tax. Okay? So in order to record this at net of tax, what we have to do is I'm going to move this other comprehensive income actually on, and I'm actually going to move this part of the income statement on the other page here, just so that's easier to follow along. And I'm going to, make this a little bit easier for you guys to read. Let me just, remove the line space in there. Okay, so yeah, the unrealized holding gain right here, since it's recorded pre-tax and it's $11,600 and the tax rate is 35%, where is that? It is right here. We have to report it net of tax, which means we're going to have to take the pre-tax number, $11,600, and multiply it by 1 minus the tax rate. Okay? Which is basically the same as doing $11,600 multiplied by 0.65. Okay? If we do that correctly, we'll end up reporting this unrealized holding gain at a value of $7,540. Okay? And it's a holding gain, right? So it's a positive number. And that concludes the other comprehensive income section. All that is left to do then is to calculate comprehensive income. So comprehensive income equals, oops, let me fix that right there. Yeah, there we go. Other comprehensive income, equals net income plus by our other comprehensive income. So $4,810 plus $7,540 gives us our comprehensive income of $12,350. But we are not done there, okay? I need you guys to remember that this is an IFRS statement, okay? We follow IFRS, and always in IFRS, at the very end, we report our earnings per share, okay? And earnings per share, right? I'll put this right on the bottom here. EPS, right? Earnings per share equals net income divided by average number of common shares outstanding. Okay? And did I misspell net income here? I think I did. Okay? That's what earnings per share equals. Okay? So our net income was $4,810. And then our average number of common shares, it's always going to give it to you in the question, was 240,000. So, we put that in, 240,000. It's going to give us our earnings per share amount of 0.02. Okay? And now we've completed the statement of the statement of comprehensive income. This is the full statement right here. Okay? So, virtually the same as, any regular statement or any regular multiple step income statement. However, we add this other comprehensive income section at the end. And we have to remember that since it's IFRS, we include other comprehensive income and we include earnings per share. If, let's say, for example, if that said ASPE right there, then we would end the statement at net income. We would actually delete all that under ASPE. But it's IFRS, so we cannot delete it. It has to stay. All right, so that's the statement of comprehensive income. All right, so we're 1/3 of the way there. And now the next step is to prepare the statement of retained earnings. Okay, so let's go ahead and do that. Luckily, the statement of retained earnings is a rather short one. And, we'll start off by doing our header. So it's now the statement of retained earnings. All right, there we go. So, statement of retained earnings, it's a short one, okay? Always what you're going to do is you're going to start with your beginning balance for retained earnings. And this beginning balance for retained earnings is going to be on January 1st, that's the first day of the year, 2015, okay? So we're going to go up to our question and figure out what that is. So, looking through all our givens here, and I'll unhighlight everything since it doesn't really matter. We have a retained earnings balance at December 31st, 2014. Now, for our purposes, the balance as of December 31st, 2014 and the balance as of January 1st, 2015 is literally a day. We're assuming nothing happened in between and that it's the same number. Okay? So, beginning balance is going to be, as I just showed right there, $521,000. So, we'll put that right in the statement here. Okay? And now this is where it's going to get a little bit interesting. And I'll get rid of that friggin' red. Okay, this is where it gets a little bit interesting. Remember how I told you guys that, this advertising expense omitted isn't included on the income statement, but included on the statement of retained earnings? Well, this is where it is included. After we list our beginning balance right here, we are going to then begin to add back or subtract any errors or adjustments that we missed in, prior years. Okay, so in this case, we're going to have a correction for, omitting advertising expense in 2014. And one thing you need to know about this part right here, about, included in these corrections and errors, is that again, right here, it's reported at net of tax, okay? But unfortunately, of course, this amount right here, where is it? Let me find it. This amount right here, it doesn't say net of tax there. So we're assuming that this $35,000 is actually a pre-tax number, okay? So that means that if we want to report this net of tax, we have to figure out what the, net of tax number is of $35,000, okay? And since the tax rate is 35%, we're just going to take, same as we did, here for unrealized holding gain, we're just going to take $35,000 and times it by 1 minus the tax rate, which is 0.35, okay? So simple enough, right? We just need to figure out what this number is net of tax, because that's just how we record it on this, statement. Okay, so if we do that calculation appropriately, then we're just going to get this number of $22,750. Okay, now because it's an expense we forgot to include, we're actually going to put it in brackets here because expenses are negative numbers. Okay, if we forgot a revenue, then it would be positive and it would add to the beginning balance. Okay, so now what we're going to do is we're going to calculate our adjusted beginning balance. Okay, and this is very straightforward. We're simply just going to take our beginning balance and subtract or add any errors that we changed during the year, or that we forgot to include in prior years and that we were adjusting. So in this case, we only had the 1, so it's just going to be $521,000 minus by $22,750. Giving us an adjusted beginning balance of $498,250. Okay? And from here on out, the statement gets rather easy. Next step is to add our net income. Net income, of course, we know what that is, right? Because we just calculated it. If I could spell it right, net income is on our statement of comprehensive income here. It's actually right here, $4,810. So we're just going to add that to the statement, $4,810. And then the next one is to subtract any dividends paid or declared during the year. So that's where dividends declared is going to come into play of $15,000. And don't worry, this doesn't have to be reported net of tax at all. So less dividends declared, and it is $15,000. Okay, so all these adjustments combined together give us, stupid underline here, gives us, a net average of about $10,190. Okay, this is basically just your $4,810. subtracted by the $15,000 here. Okay, this is just the total of the adjustments. And the last step is just to figure out your ending balance for retained earnings on December 31st, 2015. This is calculated by taking our adjusted beginning balance and then subtracting by these adjustments. So $498,250 subtracted by $10,190 gives us our ending balance of $488,060. So, as you can see, statement of retained earnings is actually very easy to prepare. There's just a few things you need to know, right? You're going to have to memorize that you add net income and less dividends declared. The trickiest part is to know how to deal with the corrections or errors that have been made in the past. You need to know that they are not included on the income statement here, but rather they are included right after we list our beginning balance for retained earnings. You need to know they're reported net of tax, right? And that if we made a mistake for an advertising expense, then it's a negative number, and if we made a mistake or forgot any revenues, then it would be a positive number, right? We forgot expenses, so now we have to include more expenses, so therefore it's negative. Okay, so this is the trickiest part right here, and I would suggest getting as much practice with it as possible. Okay, so now, very last thing that the question is asking us to do is prepare a statement of changes in equity. Okay, now the statement of changes in equity is more of a horizontal statement and one that is not easily prepared in Microsoft Word here, as you know, these income statements I've been doing right here. So I'm actually going to hop into Excel and we're just going to do it there. Okay, so here we are. We are in Excel right now, and what I have right now is just some screenshots here, so we don't have to keep flip-flopping back to Word and to the question, right? What I have here are 3 screenshots. First one over here is all the givens from the question, so you'll recognize all this information. And the second one here is our statement of retained earnings. Okay, you'll remember that. We just prepared it. And this right here is actually a portion of our income statement. Okay, it's the portion that includes our other comprehensive income down to our earnings per share. Okay, so it includes our other comprehensive income, it includes our comprehensive income and EPS. Okay, so I've basically screenshotted everything we need to know and everything that we've prepared in the past that is going to be useful in preparing our statement and changes of equity. Okay, so we're just going to move all these screenshots down here, and of course you're always going to start with your header, right? Your header is always going to be right. We are the Sabra Corporation, and this is a statement. Oh, let me fix my key here is messed up. It's falling off. My keyboard is breaking, by the way. Statement of changes in equity. No, this doesn't have spell check, unfortunately, so you'll get to see really how terrible I am in grammar. But, I won't really worry about that too much here. And then, of course, for the year ended December 31st, 2015. Okay? And, of course, I spelled December wrong. Okay? Now, this statement right here, it's actually very easy to prepare. It's just a pain in the butt. Okay? It's a really long statement, and it's just super annoying. All right? So, generally, how the statement works is across the, columns here, we're going to include all of our shareholder equity account. And then in the rows here, we're going to include every adjustment that happened. Essentially, this statement is just showcasing the overall changes in each particular shareholder's equity account that happened throughout the year. Okay? So usually what we do, first thing we like to do at least, is we throw in, first in the far right column, we add in our beginning balance, January 1st, 2014. Okay, we want our beginning balance of all of our shareholders' equity accounts. Okay, and usually we're going to have our total column. Okay, and from our givens here, right, from the screenshot, let's look at what kind of shareholders' equity accounts we have. Clearly, we have a contributed surplus account, so I'll include that. Contributed surplus. Okay. That is actually a shareholders' equity account. You may not know it, but I'll explain it in just a brief moment. But it is a shareholders' equity account. We always have our, what do we have here? We have common shares, right? We have common shares. That is another shareholders' equity account. So I'll add that in there in the rows. We also, of course, we have our retained earnings. That is another one that is popular and that we have. You can see it right there. We have our begin and balance retained earnings. So clearly we have that. Any other ones we have here? Oh, yes, our accumulated other comprehensive income. Accumulated other comprehensive income is also, I'll warp the text there so it doesn't go everywhere, is also a shareholders' equity account. Okay, and as you can see, it's just right there, the $129,000. Okay, and then of course, this is a little bit out of the ordinary. I know that I said, what we include in the columns here is our shareholders' equity accounts, but we also include a column called comprehensive income. Okay, now this one, let me warp it here. I'll throw it in red, okay, because it's a little bit odd as to why it's there. It's actually not a shareholders' equity account. However, we include it there, just to display some extra information, okay? But we'll come to that in just a bit. So the first part here is just to add in our beginning balances. So for common shares, beginning balance was $670,000. Contributed surplus, it was $290,000. Oops, $290,000. For retained earnings, it was $521,000. Now, if you notice, I can get this information right from our givens, or I can pull it straight from our statement of retained earnings here. Okay? Comprehensive income, it's not an account, so it doesn't have a beginning balance. However, our accumulated other comprehensive income, if we look at right here, has a beginning balance of $129,000. So we'll just add that in. Okay? And now the next step here is to do our total column as we go. Okay? So this is just going to equal the sum of all of these, columns there. Okay? We always have a total column going as we go. So the next step, after listing our beginning balance, is to list any adjustments to these beginning balances. And usually, we don't make any adjustments to any of the other ones except for retained earnings. Notice how on the statement of retained earnings, we had a correction for minimum advertising expense. Well, we're going to include that here. Okay? Correction for advertising expense. It's a correction for omitted advertising expense. What you're going to notice in this statement is, since this statement is designed to showcase all the changes throughout these accounts, it's going to actually replicate all the information on the statement of retained earnings, okay? They show the same thing, except for this one right here, the statement of changes in equity, not only showcases retained earnings, but showcases all of them. So after, listing in our beginning balance, we are then going to show any correction for omitting any errors. And that will only show up in the retained earnings account. Okay, so a correction for minimum advertising expense, pulling it straight from the statement of retained earnings is $22,750. Okay, so throw that right there. And then, of course, like we do for the statement of retained earnings, is we're just going to figure out our adjusted beginning balance. Adjusted beginning balance. And I misspelled that horribly, but I'm just going to go with it. Okay? So, of course, nothing changed with common shares. So, I'm just going to, copy and paste that down. Same thing, contributed surplus. Nothing changed. And for retained earnings, it's just going to be that, the beginning balance, $521,000, subtracted by $22,750. Oh, sorry. Well, since that is I accidentally put that in as a negative. So if I change that really quick, there we go. And now it's subtracting there. And we're going to get our adjusted beginning balance, which exactly lines up with what is written on our statement of retained earnings of $498,250. Comprehensive income, nothing's going on there still because it's not an account. And nothing had changed for accumulated other comprehensive income, so it is the same. Again, adjust our totals column to add it all up, along the row here, okay? So after we do that, okay, here, let me add in a little underline here so we can clearly see that this was a calculation right there. So after we do that, basically what we're going to put in these columns are things that adjusted and affected these accounts here, okay? So we'll do the retained earnings one since we have it right here in the statement. We had net income. So we're going to just put in net income, okay? And net income actually affected retained earnings. So we throw in $4,810, okay? And what else affected it was dividends declared. So we're going to throw in dividends declared over here. And dividends declared is, what is dividends declared? Dividends declared was $15,000, so we're just going to throw in $15,000. Okay, so those are the things that affected the account, that affected retained earnings, so we can leave that for now. Now let's look at things that affected common shares. And there's only one thing you're ever going to see that affects common shares, and that is issuing more common shares. And in this case, that's exactly what we did. Common shares issued amount to $110,000. So on the right here, we're just going to write common shares issued, and it is going to be $110,000 worth of common shares issued. Now we're done with common shares. We're done with retained earnings. Moving on to contributed surplus. Now, contributed surplus is a super complicated account that there's no point in me going into and bothering explaining because you don't need to know it for the course. All you need to know is that it is a shareholders' equity account and that you include it on the statement. But since it is so complicated, you're never going to be expected to make any adjustments to the account in this area since, you're really not expected to know what it is. So all you need to do is really list your beginning balance and you're good because nothing is going to happen to it. So contributed surplus is good, common shares is good, retained earnings is good. Now let's look at comprehensive income. Why the heck is this here? It's not a shareholders' equity, account at all. So why is it here? It's just here to showcase the equation for comprehensive income. Even though it is right here on the freaking income statement, comprehensive income of $12,350, we want to put it on the statement of changes in equity, again, for some random reason, okay? In order to do that, we need our net income of $4,010, and we also need our other comprehensive income. Don't know why that is blue. Let me fix that for you, okay? We also need our other comprehensive income, because remember that comprehensive income equals net income plus by other comprehensive income. Other comprehensive income is just $7,540. So $7,540. And then we're just going to write in comprehensive income over here. Do I have to write that in? Yeah, we're going to write down comprehensive income over here. I'm just going to throw in a little underline here to showcase that we're adding it up. Right, pulling it straight from the statement, $12,350. You can also do the addition here. Just make sure that it lines up and adds up because it should. All right. Now, that basically solves, that basically covers everything for comprehensive income. Now, all we need to deal with is our accumulated other comprehensive income. So what this account represents is it basically, other comprehensive income encapsulates all of the other comprehensive incomes that the firm has included for all the years in the past. Essentially, other comprehensive income is closed off to accumulated other comprehensive income every single year, okay? And if this doesn't make any sense to you right now, then just forget about it. All you need to know is that the only thing that you're ever going to put in this column here, other than the beginning balance, is other comprehensive income. of $7,540. Okay? That's all you need to know. And now these columns are now complete. And the last thing you need to do right here is figure out the ending balance for all of these shareholders' equity accounts. Okay? So your ending balance for common shares is just going to be $670,000 plus by the $110,000 that you issued. Okay? So it's just going to equal the sum of these, right? Giving us, oh shit. Okay, relax, Excel, relax. Giving us an ending balance of $780,000, right? Our adjusted beginning balance plus by common shares issued. For contributed surplus, literally nothing has changed, so beginning balance is just going to equal the ending balance. For retained earnings, your ending balance is going to be your adjusted beginning balance plus by your net income plus or subtracted by your dividends declared. Or it's just going to be the exact same as is presented on your statement of retained earnings, which is $488,060. Okay? This thing right here is the exact same as this statement right here. Okay? Comprehensive income, there's nothing we need to do. We've already calculated it. It's reported actually on a separate line, so nothing goes in this little box here. And then for accumulated other comprehensive income, it's just going to be our adjusted beginning balance plus by our extra other comprehensive income that we got throughout the year. Well, I don't know why that did that. Oh, maybe because one's a dollar sign and one's not. That's just going to be basically equal to $129,000 plus by $7,540. Right? Giving us an ending balance of $136,540. Okay? Now, this statement is basically done. All that's left is to figure out this total column right here. So obviously, this is going to equal the sum of all of this, right? We're going to add all that. And now, net income is just going to equal $4,810. Dividends declared was $15,000. Common shares issued was $110,000. And OCI was $7,540. One thing I want you to note here, okay? In this total column here, right? One thing I want you to note here is that, look at net income. Net income is reported twice. Once for retained earnings and once for comprehensive income. You see that? $4,810 and the $4,810 here. But in the total column, we don't add up net income twice. Don't make that mistake, okay? Everything that you put in this comprehensive income column, do not include it in the totals column. That is why for comprehensive income, this is blank here. We don't include anything there. And for comprehensive income, we don't add up both of them together and double up. Same thing with net income. We only include the one amount, the amount from retained earnings. Everything in this column is not included in the total column. Okay? So just keep that in mind. And with that, that is the end of the statement. Okay? So as you can see, it's a very long process. So I suggest as much as possible to memorize the steps so that when it comes to the midterm, you can just, blaze through it, because honestly, you're going to have a time constraint. But the good news is that it's not overly complicated and there's not a lot to know. Okay? So that has been the first combo question, and hopefully I'll see you in the next video where I'll cover a second one.